Welcome back to another episode of Profitless on Purpose, the nonprofit-focused accounting podcast where we talk about all things nonprofit from an accountant's perspective, and not just one accountant. I'm one of your hosts, AJ Wheeler, but we also have two other very capable accountants in our midst. First one is Mark Palardy.
Hey, how's it going?
And Lisa Sheldon.
Hello.
We have some articles lined up, 3 of them actually, one from each of us this week, and then we'll get into a roundtable discussion on the exciting topic of fund accounting. So who's going to start us off? Mark, I think you got our first article this week.
Yeah, you bet. We have an article called Not More, Better, Reframing the Problematic Dynamics of Government Funding. So this is from the Nonprofit Quarterly, and this was kind of an interesting deep dive into the nature of nonprofits and how they get funding from the government. And a lot of nonprofit funding is coming from governments these days by government grants or government programs, because frequently they can connect up with nonprofits and get the services that people in the community need. And it works better or bodes better than giving this to a company that needs to be for profit. So some of the issues that nonprofits are having with government accounting for time immemorial is that a lot of the grants that are given to them are cost reimbursements. So basically, anytime they spend money, they have to wait and then fill out forms and paperwork, and then they get reimbursed. And as with anything government related, it can become administratively burdensome. But from the government side, they're wanting to treat everybody fairly, and they have super complex procurement rules which say, you know, in order to get your money, you need to do X, Y, and Z. So this article is positing that the theory that, you know, nonprofits who go in looking for government funding, they're often saying, I need more money from the government, I need more money from the government. And this article is saying, maybe rather than thinking about more money, you should be looking at how you can get better money, how you can figure out ways to deal with the government in ways where it will be more receptive. And obviously, if you fit a niche market where there's a specific need that's needing to be fulfilled, the government is right there and wants to hire you and wants to bring you on board because they want to either roll out some program or have some metrics. So if you can set yourself up in that way, obviously that's great. But if you can't, you can also create systems in place where the cash reimbursements that you have to get from the government happen in a little more smooth of a fashion, and that you're kind of working the system in a way instead of having the system work you. I'm not going to go too deep into the details of this. The article does a nice job of laying out some of the reasons why a nonprofit might not want to borrow money, but how they can kind of work around cash flow, which is a problem and a concern for every entity, be they for-profit or nonprofit. So I thought there was a lot of juicy tidbits in here, and I'm just curious what my compatriots think about this one.
It was an interesting article, and I liked the fact that they brought up issues about how governments and not-for-profits and just organizations in general within the community can work together to make this kind of thing happen, and to help the not-for-profits if they needed financing or if they were looking for ways to do things a little more efficiently and a little better. And I think that some of those insights were interesting and very, very forward thinking. But I agree. I think that, you know, just going and asking for more money and more money and more money is really not ever going to get anybody anywhere.
Yeah, and I really think so. One of this is a drum I've been beating for a long time with nonprofits. A lot of times, you know, a funding like opportunity or a grant opportunity comes up, and everybody's just all for it, you know. And what they don't realize is that cost reimbursement. You know, this is true in for-profit too. Expansion, or, you know, bringing on more sales or whatever you want to say, in this case, more programs and grants, or adding to the amount of programs and grants, you're talking about usually a cost reimbursement kind of grant, which means you have to spend money to make money. And one of your major things that you have to spend money on is personnel. If anybody's ever looked at nonprofit financials, you're very top loaded on personnel expenses. A lot of this stuff, you go down mental health, healthcare, any of these kind of avenues of nonprofits, you're really talking about people services, people being the main driver of what you're delivering. And so, cost up front, you have to provide payroll and benefits and hire somebody through this process to be able to add programs like this if you don't have, capacity in your organization to do so. And what that means is you're going to have to issue a good 1, 2, maybe even 3 payrolls before you see your money back from the government program that you're submitting for reimbursement through. So there's a long cash float, and quite a big cash float for you to be able to meet until you actually receive money back in from services rendered a month or 2 ago. So things to consider for nonprofits when they're looking at these type of reimbursement grants is, do you have the cash flow to meet it? And if you don't have the cash flow to meet it, do you have access to like some kind of line of credit with your bank that you can apply for to be like a bridge, essentially like a bridge loan to get you through payroll? It's not like buying a piece of equipment where you can make payments on it. If somebody works hours, you have to pay them. So the money's got to come from somewhere. And so, that's one of the things I've suggested with nonprofits is that they have some kind of bridge, like whether it be a reserve fund that they can use to dip into and replenish in between those new contract starts and stops that happens, or a line of credit, or some kind of like, I think a lot of times maybe cash flow in a nonprofit isn't really thought about, but it's vital for them to be focusing on it, especially when cost reimbursements are at play here and you're putting out.
I want to jump in here because I think that's a really good point that you're bringing up, and that the article addresses as well with regard to bridging your money and coming up with lending. And one of the things I hadn't really considered was that it's much harder for a nonprofit to get lending and to get financing from an outside source, because if you think about it, for-profits, if they've got a good receivables base, they can factor those out and they can assign their receivables to somebody else, and they can get funding and lending based on that. But if you're a nonprofit who's getting a bulk of their funds from government accounting, you're not going to be able to factor out or sell a receivable from your local county or your local state, your state. It's kind of puts you in a situation where your options are even more limited. And I think this will probably be a subject we take a deep dive into, in the future, as to some of the resources that nonprofits have, when it comes to financing and some other ways that they can keep their cash flow going. Because just because you're a nonprofit doesn't mean you don't need cash to survive. So, I just wanted to interject that.
No, and good point. I mean, I think my advice to, I think you can start small in a nonprofit, and you have usually there's banks that specialize with working with nonprofits. I know locally we have some that pride themselves on having a large nonprofit practice. So I think looking into those kind of banks would help, starting small with maybe a company credit card is often, a good choice. And then, you're building essentially credit worthiness with your bank to show them that, hey, I'm paying off the credit card. Can we get a line of credit here? But yeah, great points, Mark. Do you have another article for us, Lisa?
Yeah. So I'm going to talk about 7 key considerations for analyzing the impact of COVID-19 on not-for-profit financial reporting. So this is a nice, short and sweet little bullet point kind of article that talks about really what you need to take into account when you're, for your auditing considerations, when you're starting your financial statement audit. Number one, first and foremost, in this COVID-19 era, we need to determine options for remote auditing and how we're going to do that. I think we talked about this a little bit last week, AJ, with your article and things that auditors had to think about. But they still, auditors still need to be able to get to your financial statements and to your support for your financial statements. We need to assess existing internal controls and segregation of duties as they have likely changed. Staff reductions, absence from an actual workplace, have put a lot of strain on these organizations, and many of them probably have their internal controls and segregation of duties have probably changed significantly. You need to analyze your organization's risk for fraud. You may be, it may be heightened as a result of what's going on in what's happened. There could be, improper timing of revenue and expenses. You could be, forced to apply for paycheck protection programs, things like that really need to be taken into consideration. You need to prepare for variances in auditing inventory. This may not apply to many not-for-profits, but it certainly does apply to some that have inventory. Obviously, inventory observations may not be handled remotely, or may be handled remotely and not be handled on site. You're going to definitely be prepared for additional financial statement disclosures. You're going to have some impact of COVID-19 that you're going to have to disclose in your financial statements. Accounting and auditing standard delays, you can account for those. You can report that you're delaying those. And then you identify delayed payments and waived fees. So if you've received any kind of relief from your creditors or lenders as far as deferment of loan payments or waived fees or waived interest, you need to make sure that you correctly report those and account for those in your financial statements. So those are the big things that we talked about. I don't know if you guys have any other ideas.
Well, I think the big one that's kind of sitting out there that I've seen is making sure that you account for that PPP loan correctly. I think a lot of nonprofits got that immediately, and at least the ones that I was looking at their books, they booked it immediately to unrestricted revenue. We got a free grant. But the reality is, when the auditors would come in and look at that, they're going to say it's really a loan until it's forgiven. And it needs to be classified as such on your balance sheet. Even though you're not making payments to it, you want to set up a liability account to account for that until you apply and receive, the full forgiveness on it. Then absolutely, it's unrestricted revenue for you, and you can move it to the P&L. But until such time, it's got to reside as a loan on your balance sheet and to properly account for it. Now that may be different. You may report differently to the board. I know some boards, like reports, you can, if you anticipate it being forgiven in the near future, you can move it for ease of presentation. So nobody's asking a bunch of questions what this loan is, but although that would be easy to explain. But if you have it wrapped up with something else, it might be easier to, move it for board reporting purposes. But especially for your audited financial statements, internal financial statements, I would say classification of that PPP loan is really, and the other one that they pointed out that we stressed last time was assessing your controls and segregation of duties. One thing is, I think everybody was forced to move really quickly to remote working, and just the fact that, with quickness comes change, and with change comes differences, and you may not have those separation of duties that you once had in like an office environment where somebody is physically looking at backup and stuff like that, making sure that people are able to see breadcrumb trails of what you're doing and support for what's there.
Yeah, I think you both bring up some great points. And AJ, to piggyback on that PPP loan, if you think about it, very few of these loans were forgiven back in 2020. So if you're doing a calendar year audit, it should show up as a loan until you get that forgiveness. So by the end of the year, it shouldn't be showing up as forgiveness, for external financial purposes. But, I think one of the things that comes to mind, as Lisa was kind of presenting the case, the fraud risk was really interesting, because here you've got a situation where things changed radically in the month of March 2020. And all of a sudden, at least at the nonprofit I was working at the time, people are scrambling to kind of figure out, how long is this going to last? What does our cash flow projection situation look like? Are we going to continue on with these programs that we have going? We don't know when this is going to end. And this is an area where it's so chaotic. It's kind of ripe for people who take advantage of these kinds of things to step in, either internally or externally. So I really don't envy anybody having to audit 2020 financials, because when you look at consistency in prior years, this year is going to be kind of a big mess, and you're going to have some going concern issues. And I think we even touched on last week, like, what about some of these programs and these big grants that you were expecting to get, or these fundraisers that you weren't able to have? Does this create more hassle and more problems for auditors to figure out, if you're a going concern, and if there are material misrepresentations on what's going on in your books? So good luck to all you auditors out there listening. So AJ, I think you got our last article for us.
I do. So this comes our way of Philanthropy Daily. I don't know if they have an article every day, but that's what it's called. But essentially, this is related to a book on board, The Insider's Guide to Surviving Life in the Boardroom. And so what it really talks about is a Minnesota-based American Public Radio CEO, I guess, for lack of a better word. Anyway, what this guy did was he grew basically from 19 full-time employees and $3 million in revenue to more than 40 full-time employees and $20 million in revenue. And he wrote a book about how he did so. And what this article essentially breaks down is you often hear, and I've heard it from either the board side or from an executive director side or a CEO side, and this goes for profit and nonprofit. I don't want a board breathing down my neck, second guessing everything I'm doing and micromanaging, my role as executive director or CEO. And then the flip side of that is having a disengaged board that doesn't do anything or help. They just show up to the board meetings, listen to the board minutes, and kind of chime in, great job, go home, have a snack, and go home, vote on what needs to be voted on. So essentially, this is a really good book, I think. Talks about, warned of the deficiencies in not-for-profit boards where either the paid executive surrounded its powers to the chair, meaning that the executive director or the CEO puts in place board members that are sympathetic or will, kind of on the side of the CEO, versus then volunteers one and all. They usurp their executive responsibilities to the board, essentially, and they manage via the board, where the board is more of a managing board. And both sides of that coin are really detrimental. And so what the article is saying, any institution that has an all-powerful chair or a weak CEO is an institution in trouble and is surely headed for trouble. And so I think it brings up a good point that I think, the board in a nonprofit setting, the board is there to have like a macro kind of management version and to be the, second check or the control over the person in charge, whether it be the executive director or CEO of that nonprofit. But they need to work together. And really what that means is that the board needs to step up with, donations and helping with bringing in money and opportunities for the nonprofit, as well as be be the double check on results of operations, reviewing compensation for that CEO or executive director, and kind of being a guiding light for the organization and an overall, governance kind of double check, I guess, to make sure that you don't have a person in place in power that has no check to it. So I'd kind of like to get your guys' take on it and see, what you thought. Maybe I'm just beating a dead horse here and you guys already know all this stuff, but I thought it was really intuitive, really kind of spoke to what I've seen in the past on either a weak board or an overstepping board versus, a good strike of balance between the two.
I think one of the things that I thought was really interesting, and I agree, AJ, this is a well-presented article and probably a good book. But I think it's interesting how he makes this delineation between a for-profit board and a nonprofit board, and how, the for-profit board, they're there to kind of help rubber stamp decisions and drive profitability. But for the nonprofit trustees on a board, you're both a governor and a volunteer. So usually nonprofit boards, there is no remuneration financially for being there. And in fact, you're asked to pony up money in order to sit on that board. And often there are other volunteer experiences that you can take. And I really like that. I like how that sounds, because it really goes to serving the mission of what the board exists for. So whatever that may be, whether it is a service, a health care service organization, or a museum, or even a local nonprofit bakery, if you will. There is a sense on the board that you really believe in the mission and that you're committed to it and that you want to be there to help volunteer and make this organization a success because you believe in what they're doing. You don't just believe in making the most money you can. So I kind of like the way that he laid this out, and it's an appealing article to me.
So yeah, I mean, I agree with you, Mark. I think that that the whole being invested in the board is a great thing for not-for-profits. I have seen firsthand boards that take over control and run every aspect of an organization. What I've seen is that their constituents are not happy with the services that are being provided. I've seen that they kind of shuffle through a new executive every year, 2 years. Employees are just cycling through there, and they can't understand why things are happening the way they're happening, but they're also not willing to let go of any control. And aside from the service that they're providing, which if they didn't have that service to provide, nobody would show up. And I don't want to name names, so I'm not going to say anything further. But it's just it becomes a nightmare, and you just see it, and it's a great organization. They can do great things if the board would just take that step back and say, we've hired someone who's competent as our executive. We need to let them make some decisions. So we just have to make sure we're not overstepping as board members, or as people who are working with board members, that the board's not overstepping their boundaries, especially from a not-for-profit. Yes, if there's an emergency and something big has come up, then yes, the board needs to be involved. But the board doesn't need to be involved in running the day-to-day operations. And that's kind of just board 101. But when you see it in action, it's like you got to stop. You just got to stop.
It's so true. Oh yeah. Yeah, I think it is. I think it's totally true. I was on a board that we went through 3 different executive directors in like 3 years. And I think, it wasn't the board's fault, and it wasn't any executive director's fault. It's just, I think they hired the wrong person in the wrong position. And they either, one of two things either happened. The executive director either wanted total control and it went down that route, or you went the way where the board had made too many wrong decisions and didn't trust their own decision and tried to hold on to power and get in there and usurp kind of what was going on.
Yeah, a little bit of threading the needle. You got to find that perfect mix in order to be successful. So I think that brings us to the end of our articles today. And the topic I think we want to discuss as a roundtable, we're starting a little general, but we're going to go a little more specific as we get deeper into these podcasts. But in general, we kind of wanted to touch on the topic of fund accounting. What is it? Why does it matter? What makes it different from companies, institutions, and ways of accounting that are not fund accounting? So, AJ, you want to kick us off?
Yeah, I'm everybody's favorite subject when they were studying FAR for the CPA exam, right? Governmental accounting, fund accounting, upside down income statements, where your expenses come first, because government's just got to be different. But it wasn't always this way. Fund accounting actually used to be the way that nonprofit accounting was done. So I think, I don't know the year, but a long time ago, when pencil and paper were still in use, fund accounting was actually used as not the nonprofit standard as well as governmental accounting. And to a certain extent, you still see that today. Like, I guess you see in classes, I guess is the best way to show it, like in QuickBooks, where you're accounting for programs by class. But in governmental accounting, it's essentially, it's siloed. It's its own like profit and loss and balance sheet essentially for each department, I guess, if you think about it that way, or governmental unit that these funds are used. So I think it's an interesting topic, but it's definitely, I guess, from my perspective, when I used to be an auditor, you had your regular nonprofits, and those, they didn't really use fund accounting. They used a type of fund accounting, I guess, by bifurcating their revenue and expenses into categories based on their grants. But realistically, when we would do a governmental audit, that's when you would really see the fund accounting kick in. And there are special rules and kind of designations that happen there, and different reconciliations that happen along, going from like the very small governmental unit all the way up to the top kind of master statement that they would show, that they would present in the governmental financial statements. But maybe I'm off base here, Mark. Were you thinking of a different kind of fund accounting?
Well, I mean, you can't spell fund accounting without fun, right? So, I think fund accounting, just a little more fundamentally, if you will, is putting money into different buckets. And most of the nonprofits I've looked at, and granted, I'll admit I don't have a lot of governmental experience, but most of the nonprofits I've looked at and worked with have some form of fund accounting, like you said, AJ, and a lot of it comes from restricted money coming into these entities that needs to be tracked, right? If I'm a donor and I say, I want to give $5,000 to this specific program to be used in this specific way, then I, as the nonprofit, need to have a bucket for that specific use where I can track that money coming in and coming out. And, technically speaking, if that money is restricted from a donor, if I'm that donor giving $5,000 and the nonprofit only uses $4,500 of that, technically they're supposed to go back to that donor and say, hey, we didn't use all your money. Would you like that back, or would you like us to roll it into our general non-restricted bucket? So fund accounting, in my mind, has kind of always just been, buckets of money that we classify in a specific way. And I welcome you to explain if it's a little different in a government accounting. But this is the way that nonprofits can really track all their different programs. And the more complex the nonprofit, the more different types of restricted projects you might have. And, you might just have two main funds, which are your non-restricted and your restricted money, but you're going to have kind of these tendrils that go all over the place in order to track all this money and its usage. Lisa, I'd love to hear what you have to say on this.
Well, from a governmental perspective, I mean, you do have the funds, right? You do have, but when you're looking at it, some of them are, I guess, funds that only receive governmental monies, like a general fund would only receive tax monies, kind of thing. And then you might have service funds, where it might be a pay for service. So it might be a city water department. So it acts more like an actual revenue generating business. And so you do have those different kinds of things when you're looking at in a government, like if you were looking at a city or a county, perhaps you would see those different kinds of funds within the organization, and both working in different ways, right? One is really just, I'm relying only on property tax revenue as the basis for my revenues, or income tax revenue, or whatever that case may be. You also do have a lot of grant funds where you are segregating the money and accounting for it in the same specific way that you would at any other organization, not for profit, that is receiving grant money. So you do get similarities between the two, and again, back to the whole fund issue. The one thing that I see that's a little bit different in governmental accounting is what they call it. They're more on a modified accrual basis of accounting. They do something called accounting for encumbrances. And so an encumbrance is when I have decided I've issued a purchase order to buy something. And so because I can't spend more money than I have, or that I'm going to get, that I've budgeted, at least in the state of Ohio, you can't spend more than you're budgeting. So you have to do what they call encumber the funds, which means kind of set them aside and pull them out of your budget so you don't spend them on something else before the invoice comes in. So it's not truly accrual accounting, but it's kind of some modified type of accrual accounting. And so that makes it a little bit different and a little more, it's a little unique, but, and it makes it a little more cumbersome. especially for those people in purchasing. Because they got to record all those encumbrances once they send a PO out.
Don't forget about the poor auditors. They got to audit those encumbrances and trace back the 5 different purchase orders, the change orders.
Yeah, and I would say, Lisa, the key word that you used there was cumbersome, because, fund accounting makes life a little more difficult no matter who's using it, because it really is an extra layer, sometimes an extra 2 layers of tracking the money to make sure that it's going to the right places. And a for-profit business usually doesn't have that kind of situation. They may have different classes that they're putting money into, but often there is one general fund that they're spending the money from and, borrowing against and using as their cash flow.
Maybe we could talk strategies, like quick, like give our kind of like 2 cents on how, we've seen or what we suggest as like good ways to track different fund accounting, because there's more than one way to skin a cat, as the saying goes. And I guess I'd kind of like to get your guys' take on, like, especially for a small nonprofit, if they're entering into different contracts and grants. I've run into the situation where they're not aware of like we talked about classes, but also too, you can kind of, you can run the same kind of reports and such off of tracking it by customer, in a customer center through like QuickBooks and stuff. But I'd like to get your guys' take and, maybe throw out some, things that you've seen in your experience that maybe would help somebody kind of think about this in a different way or set it up in an accounting system.
Yeah, I can jump in here first. I think, it's tricky because there are lots of different programs out there. There are specific nonprofit programs like Abila, MIP, or Blackbaud, Razor's Edge, Financial Edge, those kinds of programs that are specifically built to do fund accounting. But I think you have to reach a certain size and a certain scale in your nonprofit to make those cost effective and worthwhile, because they're not cheap. But if you're just starting out in a small nonprofit, you can do a lot of these sorts of things in QuickBooks, Xero, et cetera, either using a class system, as AJ has alluded to, by designating specific expenditures to a class. The tricky part with that, though, is what if you have a program that can get both restricted and unrestricted money, right? Because usually you're not going to have enough restricted money to cover the entire costs of a specific program. So you have to be able to have a class that has maybe a subclass that's restricted and unrestricted portions. So that gets a little bit interesting, and detailed, and you got to make sure you're tracking all that money correctly. And as the money is being spent, then you're moving the restricted money and using that up first, right? Because you want to use up all your restricted money before you use your unrestricted. The other way I've seen it done is just using a general ledger account, right? Where you're not using classes at all, but then you have this ridiculously busy chart of accounts where it's just like, and this kind of works when you don't have too many programs going on, right? Maybe 3 to 5 programs for the entire nonprofit, so that you can keep track of it in a relatively easy GL. Because once you start adding every single project to a different GL line, you can see how long that P&L, statement of activity can get. So those are some of my thoughts.
I have only worked with big not-for-profits and big governmental entities, hundreds of millions in revenue for both. And they've both had big systems and, IT groups and the whole, support network in place. So I have not worked with a small not-for-profit, but, I'm seeing, I can agree with AJ on that whole, using the classes, maybe, like you said, for smaller. I've only got 2, 3, 4 grants that I'm dealing with. But Mark, it could get ugly. You're right. It could get ugly really quickly if you start adding a new account for every single one, or every single grant, every single type of program that you're running. It could get ugly really quickly.
I would say one of the things as an auditor we used to recommend was you track your restricted funds using just a deferred revenue account. Although it's not deferred revenue, You know what I mean? Like you can kind of park it there, and as you release it, so say you get a $10,000 grant to do work on a wetland restoration project. Instead of putting that, we all know that it needs to go to the income statement when you receive the grant, when you sign the grant contract. The revenue needs to be recognized. So an auditor or your financial statement presentation needs to show that as revenue for that program. But what you can do is you can bifurcate it or like silo it off and put it into deferred revenue. And as you go through the project and you release those funds through the expenditures and the completion of the project, you can move that money from the deferred revenue, and it's easier for a board to see. I think when you're reporting to a board to see it that way. And I think it makes much more intuitive sense for somebody that's not maybe a financially savvy or nonprofit savvy to understand then that like it really does act like a deferred revenue piece almost, where you have this money up front that you need to spend on a certain project. And if you track it in that way, then I think it's pretty easy to be able to show how far the completion of the project is when you're not doing like a cost reimbursement grant. And I think it makes it easy for you to show then the board essentially, what part of that is complete. Because if a board say let's use the $10,000 wetland restoration grant as an example, they think, wow, we got a bunch of money in this month and we have a positive bottom line. Let's put that into a board reserve fund or something like that. And you're constantly, wait, this money is restricted. What you're not seeing is that we need to spend this $10,000 to restore the wetlands that we promised we would. So from like a internal financial reporting standpoint, I think it's an easy move if you put it into deferred revenue, book it on the balance sheet, and kind of release it over time as you're completing this project. Was one of the tricks that we used to, or one of the suggestions we used to give to nonprofits on tracking their funds. The other option too is to have like a very basic outside Excel sheet that tracks by grant how much money, restricted grant kind of tracking sheet, how much money is in, how many expenses have gone toward that restricted grant money, and then essentially what's left over in a very basic one line per grant kind of agreement. And you can pull those expenses directly off the P&L by class, for that grant is usually the way that we would ask, or we would suggest somebody would structure their like restricted accounting for that.
Well, I think we've had plenty of fun with fund accounting this afternoon, so I think we could probably call that conversation, put a pin in that, and have a conversation for a different day. Okay, thanks for joining us for another episode of Profitless on Purpose. We've enjoyed talking about nonprofits from an accountant's perspective here today, and really would appreciate a like and subscribe, or rating us on your podcast app. And please join us next week for another episode. Have a good one.
See you.
Bye.